Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the contrarian trading during wars.
Hello everybody, my name is Radovan Vojtko, I'm CEO of Quantpedia. So today we will discuss a really serious topic, and it's how to trade and invest during the wars and the global conflict. So there is an old saying, it's probably said by Baron Rothschild, 19th century British financier, and he said that the time to buy is when there is blood in the streets. What does he suggest is that the best time to invest and to buy something is when there is a war or there is some major conflict, because the prices of the assets are usually low at that time and there are not very much people who have the guts to buy something. When we enter the market at this time, we are contrary investors. Now the question is if the data supports this idea to buy when there is a problem or there is a major conflict. So let's take a look on hard data and check whether this idea is valid. Firstly, we will take the research paper from Mai and Contrarian from 2022. So what they took is that they took data about 160 years of wars and disasters in markets. They have a very interesting methodology because they are using information from New York Times articles. So they are looking for a keyword war in articles and in the titles of the articles. And they are checking whether there is an increased number of articles with this keyword in New York Times and what is the performance afterward. They have really long time frame to use, so 160 years. They are checking also other critical events like recessions, bank failures, disasters, epidemic, etc. What they found out is that only the keyword war is really statistically significant. What they found out is that it's partly true. So one standard deviation increase in the war or in the number of articles with the war title predicts 3.8% increase in annualized success returns in the next month. But one thing which is important, so it's 3.8 annualized excess return in the next month. So it means it's like 0.3% per month. So it's not very high return, but it seems that there is some statistical significance and that there is some merit in the saying that it doesn't make sense to buy when there is a war. So what we did is that we tried to find something or try to replicate the results and to check and build our own tool on top of that. What we did is that we built a database and created 100 years history for bonds, stocks, commodities, FX, etc. And then we ran out the analysis, what is the performance of those assets after some significant shocks. We were interested to see what is the performance of the bonds after significant one-day shock, what is the performance of the equities after a significant one-day shock in the stocks, etc. We can expect that this one-day shock is also connected somehow to wars. So what we can see that when there is a market crash or something like that, so on the first day, the usual performance is something between -5% and -17%. Average performance is positive, but not after 1 month, not after 1 week on average, but usually it takes multiple days until the recovery. On average is around 1 month, but it can take several years to recover from such shock. What we also did is that we created a list of biggest geopolitical events of the century. So we just not take a look on the data, and we didn't try just to identify war or major problem just from the data alone, but we also created a list of important geopolitical events like major wars, international crises, the president and US president's health. So we are also interested to see what will happen in case somebody will shoot a US president. We created a list of major wars, and here is the performance of the stock after the war or during the war. So we selected 2, 4, 6, 8 major wars. We are not counting at the moment the war at the Ukraine. The reason for that is because it's not finished yet, and the article was sealed in 2022. And right now it's 2023 and the war is still raging in the Ukraine. What we see, so usually at the beginning of the war, the market reacts very negatively. So there is negative performance -1.3%. After first week, we are still in the negative numbers, and after first month, we are still in the negative numbers. So it takes around 1 year until the US equities turn back and they are back in the black numbers. There is still recovery, so on average, it takes around 140 days. So it's around 6 months to recover from the beginning of the war. That's how they look during the wars, but we don't have always the wars. Sometimes we have very important crises, like, for example, there is a Berlin blockade in 1948, the USSR, the Soviets or Russians test of atomic bomb, the Russian test of hydrogen bomb, revolutions, Berlin Wall crisis, Iranian hostage crisis, etc. So These are the international crises that doesn't start the war, but they could start the war. They were also very important. So how does the performance look during those crisis periods? Once again, the first day reaction is not so strong as during the war, but performance after first week and first month is still negative. So we still need to wait a little longer, but the days till the recovery are shorter. So around after 1.5, 2 months, the stocks recover after the international crisis. And after 1 year after the international crisis, the stocks are usually significantly positive and more positive than in the case of the war. Now the question is, what is the performance of stocks after there is a deterioration in US president's health? So what does it mean? So we checked 4 events in the past 100 years. So the first event was Eisenhower heart attack in 1955, then assassination of the Kennedy, of course, in 1963. There was attempted assassination of Ronald Reagan in 1981. Trump tested positive for COVID-19 in 2020, and there was a fear that he may fall significantly ill or die from the COVID. Surprisingly, the health of the US president doesn't affect the market as much as one might think. So that's very interesting. So it seems that the war is more important than the health of the US president. Yeah, the assassination of the Kennedy, after the assassination, the market fell -2%. After 1 week, market was also already in the positive numbers. And I mean, after 1 year, the market had a healthy positive performance. So the US presidency is important, but not so much important. So it means we do not need to worry somebody should the next president. There is a vice president and there is a whole chain of power, how the power will go from one man to another man. So the country will work in the US very well, even when the president dies. So it's not like some dictatorship or some third country or in Africa or something like that. So this is how does it look like when there is a war, when there is a conflict. If you are interested to learn something more, we have a few more articles. So there is an article called Nuclear Threats and Factor Performance, how the stocks and other factors perform when there is a fear of nuclear conflict. It was, very important to know during the beginning of 2022 when Russia invaded Ukraine. There was a fear that it may start a nuclear conflict. Once again, we checked what are some important dates which are connected with the nuclear threats, the first test of Soviet atomic bomb, the first test North Korean nuclear bomb, etc. And we checked what is the market performance during those tests. Usually the market doesn't react at all or not very much. We were also checking what is the factor performance and performance of different factors during the Cold War crisis. So it's very similar to stuff we did here. Once again, we prepared a list of significant events during the Cold War, Berlin blockade, Korean War, Suez crisis, etc. And we checked what is the performance of not just US equities, but also other factors. Very quick takeaway. Usually, on average, market recovers, but it takes some time. There are some safe haven assets that do not perform very well during such crises, such as utilities, for example. The energy prices proxy or energy prices usually goes up, which is logical, and it happened also during the last crisis in 2022 when Russia invaded Ukraine. So energy prices went up. Thank you very much for your attention. As I mentioned, if you are interested, all of the articles and all of the charts and all of the links are in the description. What is the takeaway? The final takeaway. So there is some merit on the saying that it makes sense to buy when there is blood in the street, but it's not without the risk, because not every conflict ends up really fast. So usually we have a very long conflict like Second World War. And in this case, it takes really long for equities and all of the assets to recover. So it's not without the risk, but it makes some sense, and there is some merit in contrarian investing. So thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.